Thank you very much. Good morning, ladies and gentlemen. Thank you, Judith. When our chairman and Judith asked me to contribute to this process and briefly open the discussion today, they both said work from the top down. And so I'm just going to show you 3 slides which I hope will set up the discussion that we're going to have through the day. The first is, I think, appropriately long and historical. The vertical bars show GDP growth in real terms, growth of real GDP, for the group of 7 countries taken as a whole for a very long period, pre and post the Second World War. And immediately, some points I think leap out at you, although it's a chart which warrants a lot of study. The first is just how variable economic performance was in the pre-Second World War period. Many episodes of substantial fall in GDP. By contrast, the period since has been much steadier, with really no falls in GDP at all until the great financial crisis, which we're just emerging from. I think the second striking feature is the way in which growth for that group of Western economies has trended downwards ever since. At the beginning, you might say that was recovery, but nonetheless, it has been trending downwards. That's something that previous speaker Olivier Gerson alluded to when he said that this is an international issue. Now, if you put up exactly the same chart for the 4 big European countries, you get an almost perfect replica of that. So what we're talking about today is something which characterizes the Western countries. And I think there can be little doubt in there that a large part of the story of that recovery was capital movements and investment. Looking at that chart, you would have said, I expect the world to be even slower now than it has been. You would have projected that trend. That's without the crisis. And then we had the crisis as well. And these crises, as we know, are expensive. That's an average of typical crises taken from OECD data. And what it shows you is that the typical financial crisis causes GDP to be about 10% lower than it would have been otherwise. And while it typically recovers to grow at something like the rate it did before, it usually does not close that gap. And the main reason for that is a collapse in investment. Investment typically falls by about 30% relative to where it would have been had it stayed on that extrapolated trend. So 2 reasons, therefore, for wanting to see capital flows to the greatest extent possible, to finance investment to the greatest extent possible. 1, for long-run growth, the second, to minimize the effects from abroad. And just to emphasize the point about how importantly what has happened to investment has been, take a look at that chart. Notwithstanding the very low interest rates we've had, business investment in all of those countries still remains below its previous peak. For reasons we know, excessive debt, depressed animal spirits, banking sector dysfunction, and few alternative sources of finance. And to the extent that we can link ourselves, remain linked, particularly when there's a crisis, to the parts of the world that do not have problems, that is a plus for all of us. So that emphasizes, if I may, to conclude, the importance of capital flows in sustaining growth, and the importance of capital flows in linking us when we have a crisis to parts of the world which are faring somewhat better. Thank you very much, and I'll hand over to Reinhard.